That's the structural support. And on the cyclical side, we do expect 325 basis points Fed cuts to boost ETF holdings and provide cyclical support. That's the base case. But what's exciting about gold as an investment opportunity is the hedging risk. If you look at the two main risks that our US economists have laid out to the benign 2025 outlook, it's tariff escalation. And what did we see in 2018 when former and incoming President Trump announced tariffs? Gold ETF holdings and net spec holdings surged. The second risk to the US economic outlook is that the market starts to worry again about sovereign debt sustainability issues. And that's also an environment typically where gold tends to rally.
Do you find it peculiar that we're seeing some of these moves in gold, particularly through last year, at a time where the dollar is so strong against other currencies, like the euro, like the Chinese currency? Does that add up to you?
So we do find that rates are significantly more important than the dollar for ETF holdings. The big puzzle of the last 2 years has been the disconnect between strong gold prices on the one hand and on the other hand relatively high rates. The main reason for this decoupling in level terms between gold prices and the level of interest rates is structurally stronger central bank buying. But if you look at a higher frequency, if you look at changes, this relationship is very much intact. And in fact, our forecast for Fed cuts helps to explain why we expect gold prices to rise higher. On the dollar itself, we do, for instance, think that central banks who typically buy gold with dollar holdings are not going to be deterred by a stronger dollar. We also find that once you control for the level of rates, the dollar doesn't really matter for ETF holdings. And if anything, if we're in a strong dollar environment because of concerns about downside risks and tail risk, that's an environment where both the dollar and gold tend to benefit from safe haven demand.
Last year, people were really excited about gold as a possible inflation hedge. They were worried about upside inflation risk, and they were piling into the precious metal. Do you think at this point we have established gold as a better hedge against inflation than even oil?
I think it all depends what drives the inflation shock. If you were to see a negative energy supply shock, whether it is in Europe on the European gas side, or whether we would see fewer barrels coming out of the Middle East, for instance, because of Iran, then I think energy is still your place to go. Now, if inflation is, for instance, driven by markets becoming concerned about the credibility of the central bank, then gold tends to really rally. So I think it really depends on what's driving the source of inflation, and so we see a role for both energy and gold as inflation hedges in portfolios, even if our base case for energy prices is quite flat.
What's interesting to me is, as a commodity strategist, you kind of are increasingly touching all the different aspects, whether it's global growth or whether it's the idea of a debasement of a dollar and sort of some of the geopolitics with respect to looking for some sort of new currency. I am curious, when it comes to global economic trends, how much we've already baked in weak China, as we were just talking about, to oil prices, given the fact that that's been a known story and that we've been talking about how the pessimism is baked in, but not necessarily any optimism of a revival.
Yeah, so what's striking about oil prices in 2024 is that they came down somewhat in the second half, even if inventory levels, typically the key fundamental driver of oil prices, edged down. So in the first half, as in 23 and 22, we actually thought that oil prices were a little bit too high relative to inventory fundamentals because the market was focused on downside risk to supply from Russia and the Middle East. In the second half of last year, this flipped. The risk premium turned negative, and the market became focused on downside risk to China demand. The fear of an oversupply oil glut in 2025. And we think that the rally of the last few days partially reverses that. It's the sixth consecutive week where US crude inventories grew. And so our view is that oil prices are a few dollars undervalued right now. And that's why we look for Brent in the mid-70s, a touch above the low 70s we have been trading in for much of the last month.
We mentioned Chinese bond yields rolling over. There is some real fears about where growth is in a country right now. Where is demand for commodities in China? How are you tracking things?
It is very divergent across commodities. What's, for instance, quite striking is that if you look at the increases in demand for aluminium or silver, it's entirely driven by solar PV installations. If you're looking at ferrous demand, iron ore, steel, it's quite weak because the property sector continues to contract. And even on the energy side, there is quite a lot of divergence, with in 2024, LNG demand being pretty firmly supported by a strong export sector. but oil demand contracting slightly last year because of the quick transition to EVs and LNG-powered trucks. So the overall answer is, it depends on what commodity you look at. What's the implication for investors? You need to be differentiated in your investment approach if you think.
Well, if I look at iron ore and steel alone, doesn't that tell me the economy is pretty weak? Doesn't that give me the better cyclical read on things?
It gives you a very good read on the property sector, which continues to be very weak. But you are seeing pockets of strength. You mentioned the trade-up program for consumers. We're seeing very strong appliance sales. We're seeing strong EV sales. And that's positive for the base metals.
When we talk about some of the transition to green energy, we talked about how that was one reason why there hasn't been as much demand for oil, even as you did see the U.S. increase electric vehicle usage, et cetera. Do you still think that that's a case to be made at a time where people are saying that the big challenge, especially with the AI transition, is there just isn't enough energy sources, and you need to even start burning coal again in mass amounts because you have to basically fortify some of the energy demands?
So we think that global energy demand will continue to rise very significantly because the middle class in emerging markets will continue to require more energy, and because of this new source of energy, and especially power demand growth, which is AI. Our equity analysts are quite bullish on U.S. power demand, expect a 90 gigawatt increase by 2030 for U.S. power demand coming from AI and data centers. I think the big challenge will be with a lot of the additions on the power side coming from renewables, which is an intermittent source of supply. How are we going to serve all that extra power demand when the sun is not shining or when the wind is not blowing?
Well, this is the reason why. Are we underestimating how much demand there's going to be for oil, for gasoline, at a time when potentially you can't get enough power? And that's been the discussion that we've had with every single technology analyst who's come on this show.
I do think that the world needs to invest more in the power sector, in the grid. I spent my holiday vacation in Puerto Rico. It was a terrific time there with the family. But we had power outages, not ourselves, after we left just a few days ago. We had very significant power outages last year in India, where power demand is growing at almost 10% of an annualized rate. So I think that's one of the major challenges for the commodities complex.
Dan, appreciate your time. Thank you for being with us. Dan Stryven there of Goldman Sachs on the commodity market with a range of calls, including gold, getting back to 3,000, back towards 3,000. Gold this morning, just about unchanged at 26.58. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Political instability in South Korea continues. Anti-corruption investigators in the country tried and failed to arrest impeached President Yoon Suk-yeol. They wanted to question him as part of an insurrection probe after his martial law declaration in December. Opposition politicians are urging the anti-corruption officials to try and rearrest Yoon again immediately. Yoon's representative called the arrest attempt illegal. U.S. bank reserves have fallen below $3 trillion. That is the lowest since October 2020. A Fed report states that reserves fell by about $326 billion in the week through January 1st. That's the largest weekly slide in over 2.5 years. The decline attributed to year-end dynamics, quantitative tightening, and loan repayments. The Fed's continued removal of excess cash as it shrinks its balance sheet is raising concerns about reserve scarcity. Meta replaced Nick Clegg as its president of global affairs with Joel Kaplan, a longtime executive with strong ties to the Republican Party. Kaplan has been advocating for allowing more speech from across the political spectrum on Meta's platforms. Meta has been working to repair its relationship with President-elect Trump, who has accused it of censoring conservative speech. And that's your brief, John.
Hey, Danny, thank you. Just an absolutely fascinating story in the last 24 hours. There's been a real sense, I think, in this country and beyond that we've shifted away from freedom of speech towards preferred speech, and a sense that liberal voices had the power in determining who could and who couldn't speak. There is another data point there in the last 24 hours that the wind is changing big time.
The Liberal Democrat from the United Kingdom being replaced by the Republican advisor to George W. Bush. A real question about what that means going forward.
Says a lot. We'll pick up on that story in about 45 minutes, so look out for that conversation. Up next, the strength of the American labor market.
If the unemployment rate flattens out at 4.2, 4.3, then I think the Fed's going to feel very, very confident about the labor market, and it might be difficult for them to cut any further.
That conversation up next, live from New York. You're watching Bloomberg TV.
case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Can we get a bounce on this stock market? 5 days of losses on the S&P 500 so far this Friday morning, positive by just 0.2%. Under surveillance this morning, the strength of the American labor market.
We are seeing some signs of softness in the labor market, but it's been very gradual. And as long as it remains gradual, I think we can feel pretty confident that we're going to avoid a downturn. And better yet, if we actually flatten out, if the unemployment rate flattens out at 4.2, 4.3, then I think the Fed's going to feel very, very confident about the labor market, and it might be difficult for them to cut any further.
So here's the latest this morning. Investors looking ahead to key dates this month, starting with next Friday's payrolls report, followed by CPI and a Fed rate decision at the end of the month. Claudia Sam of New Century Advisors noting the Fed's summary of economic projections isn't living up to promises, writing, tension has been building around the SEP at the Powell Fed. The Fed has long been data-driven in its decisions, but the complexities of the post-pandemic economy have led it seemingly to rely on data over forecasts. Powell even admitted as much at the press conference. Claudia joins us now for more. Claudia, welcome to the program and a very happy new year to you. It's good to see you once again. How is this complicating decision-making on the FOMC?
Well, I think, a real theme of the last FOMC meeting was how much uncertainty there is about the outlook for 2025. And a lot of that comes from policy uncertainty, out of fiscal policy. But, the Fed has increasingly under Powell become very data-driven. And it's hard to believe it, but I think we're actually going to see a year where the data plays an even bigger role. And we already know that that can create a lot of unnecessary volatility because it's hard to measure a $30 trillion economy in real time with a lot of accuracy. So I think we're going to continue to see this real overreaction. And we saw this yesterday with the initial claims for unemployment data, to just, these little scraps of data we get on how strong the labor market is, how hot inflation is, so buckle up.
Well, Claudia, this is a reason why people can't liken the moment that we're in to a dark room with a blindfold on, with lots of furniture going around and trying not to bump into anything because the data is messy. We keep talking about distortions, but forecasts have been wrong. And the whole concept of transitory is a huge scar over this Fed. So is there a forecast or an economic model that they should be following? And I'm asking you of the SOM rule, who has come out and talked about how every rule has its exceptions and it's difficult to really come up with these.
Right. Yeah. This is the past 4.5 years have not been kind to rules or rules of thumb or how it's usually in the past. But we also can't become hamstrung by a mistake or a misjudgment that was made in 2021 about inflation, right? We have moved forward, and we've seen the economy slowly over time heal. We're seeing patterns that make a lot more sense than they did in the early days of the post-pandemic recovery. So the Fed, yes, and that's exactly how it feels. In a dark room, moving, we know there's furniture, but part of the Fed's job is to help turn the lights on and at least chart a path. And yes, that could mean redirecting, but to just, well, what we do this next year, it's going to be all about the data points we get. That really sets up, I think, a lot of unnecessary volatility. Like the Fed is injecting volatility because it's saying, just follow those data points. And we know we get bounced around by them. So you need to have a grand plan in terms of how you're working your way through the year. It's tricky. Like the policy uncertainty is real for this year and for the Fed. So I'm not saying like I have an easy solution for them, but now is not the time to back away from some of the forward-looking, the heuristics that we have.
Mohamed El-Erian would agree with you, and he's talked about this as much, the whole over data point dependence. What patterns are you observing that you think are going to be important and prescriptive for what's to come in the U.S. economy?
Right, so I keep all eyes on the labor market. I think that's such a linchpin to the resilient economy we've had and the ongoing recovery, in addition to millions of Americans' lives really depend on their paychecks. And this is one where I worry that the Fed is somewhat complacent. I think they're being hyper-vigilant on inflation, as we know the Fed often is and should be. But their outlook that most of the officials laid out in the last Summary of Economic Projections is a pretty optimistic one on the labor market, and basically saying, hey, we're back to normal. We're back in, I think Mary Daly even used the words kind of an equilibrium. We got one vacancy for one unemployed worker, and it's close to what the Fed thinks the long run unemployment rate is. And they project that to stay with us. Like, hey, we've got back to equilibrium. We got back to a good place. We're going to stay there. And I think there's a lot of other dimensions you can look at the labor market, particularly the differences between the hiring and the firing. The hiring doesn't look so good. The firing looks really pretty great. Like that's not typical for a labor market, that's in balance, that's in equilibrium. And so I think there are some signs, and that's what we have to keep an eye on, are the places where it doesn't make sense. And another big piece is we've had a big push from the increase in labor supply, from the immigration into this country, which has been extraordinarily high in recent years. And that's turning. Even if we don't have mass deportations, we're not going to have a big push from the outside immigration. And that's been an important dynamic of the labor market. We're going to watch it unwind. So I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it. I mean, we're going to get our first taste of the data next week with the report.
Payroll's coming on January 10th. Just quickly, Claudia, how unusual would it be for unemployment to stabilize at these levels after coming off the lows to the extent that they have?
It would be very unusual to stabilize and hold in this place for like the next 3 years, which is essentially what the Fed is projecting. But that's saying that we're in a good place and we're going to stay there. But there is a sense that, barring a lot of this policy uncertainty this year, 2025 really could be, it still could be, but it was on path to be we get to the sustainable place. We work out some of the last disruptions. So we'll see.
I hope you're right. Claudia Sahm of New Century Advisors. Claudia, appreciate your time. Thank you. I think we all hope Claudia's right, because that would be absolutely fantastic if we could stabilize at these levels.
It is people's lives, and that is the reason why it is such a dominant indicator that we will be getting next Friday, not this Friday.
The payrolls report a week away. In our survey, the median estimate 153K. Coming up next in the next hour of Bloomberg Surveillance, Emily Rowland of John Hancock, Isa Voltansky of BTIG, Tom Narad of RBC, and Terry Wiseman of Macquarie. From New York, this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self